Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this conversation, the INDepth, Richard, where we'll be exploring the new fixed income regime. I'm delighted to be joined by Senior Client Portfolio Manager at Franklin Templeton Fixed Income, Richard Rauch. Great to have you.
Good to see you, Laurence, again.
There's so much to unpack that's happening in the world that's influencing bond markets, structural changes in society, inflation, but there's also so much happening for advisors and their clients. Let's unpack one thing, which is congratulations. Fans of this series will know that you last appeared under a different title. Could you just briefly capture what that means and how it helps people?
Sure. So this is broader than just me. This is our broad mantra at Franklin Templeton, which is one Franklin Templeton. So we want to present ourselves with one voice to our clients. And to that vein, so Brandywine Global is now part of Franklin Templeton Fixed Income. This is now a $300+ billion US business. Brandywine is just one of a number of pods. Most of my colleagues happen to be based in Philadelphia, but we have colleagues in Boston, in New York, in California. The list goes on around the world. And each of these pods are operating independently with their processes, with the mandates that our clients gave us. So we like to think this gives clients the best of both worlds, right? Where we are delivering on the strategy they gave us. They're getting a differentiated process and team, same process, but we can then collaborate globally. And it's times like these where that's really beneficial, where we have access to experts all around the world.
So Richard, let's start with the macro. A lot to unpack. What do you think are some of the things that advisors and their clients are misunderstanding about the current environment?
Right. So the first thing I'll say is let's address the elephant in the room. And so that elephant in the room is what's going on with the conflict in the Middle East, the associated energy shock, and other shocks that may or may not eventuate. So this can be a very humbling business. So I'll just say that I don't have all the answers. This conflict in the Middle East is going to have an impact on the macro environments. It's already had an impact on markets. I think in terms of what's being misunderstood, I think markets may be actually understanding this and investors are understanding this. They're getting the joke right now, which this is not perhaps just an inflation shock. This could also be a growth shock. So demand destruction. And we're seeing a little bit of evidence of this in the data, but really to date, notwithstanding what might happen today or what happened last week, mostly it's been concerns around inflation. So a repricing of central bank expectations from cuts to often, in many cases, hikes. Long end bond yields have drifted up for sure in the developed world, the emerging world, all around the world. So the question then is what happens with growth? Inflation story has really impacted things twofold. The first is that central banks clearly taken out some of the cuts, or markets have taken out some of the cuts in the market from central banks and often priced in hikes. So that's number one. Number two is the long end of the curve or longer dated bond yields have drifted up. Now, what's important to note is this has been all a real yield move. And what does that mean? That just means that inflation expectations in the long run have actually been remarkably well anchored. So really, it's just investors requiring an additional premium to buy longer dated bond yields. Now, this could reverse course very quickly and may do, but right now, that's what's been happening on the inflation front. We tend to overshoot these things, and we'll get back to that in a second. Then on the growth front, so we went into this whole situation with, we thought, a cyclical growth upswing, really being driven by the U.S. I mean, the U.S. is, biggest economy in the world, driving financial markets, driving Australia, and has been remarkably resilient in the face of all sorts of things, tariffs notwithstanding, right? And so that cyclical upswing has been due to, well, there's this big fiscal impulse that's coming through this year, the one big beautiful bill that everyone I think has heard about. That'll be increasing consumer spending, central bank potential cuts, right? And then all of our leads have been pointing to a bit of a cyclical upswing, partly driven by the kind of CapEx in the AI world. We can get back to that as well. Now the question is that all intact? Well, central bank cuts, maybe not. The fiscal, well, that money might be paid to higher gasoline or petrol prices instead. And so it does temper the enthusiasm on the growth outlook, not calling for a recession. So often get a question, oh, what's your probability of a recession right now? Well, I jokingly like to say it's about 15%, because on average, there's a recession every 6 or 7 years post-World War II, and that works out to about 15%. So it might be a little bit higher than that, but that's definitely not the base case, given that we're going into this kind of on strong footing. So the question then, I guess, in the longer term is what happens? And I like to remind people, I'd say one of the most misunderstood concepts, or I guess fears out there, or biases out there, is recency bias. So I have it, you probably have it, we all have it. It's really human nature. I'll give a couple quick examples and how to think through the current situation. So if we rewind the clock going back to the GFC, post-GFC, I'd say the biggest mistake that investors have made in the entire period since is they didn't get bullish enough following the GFC. Why is that? Well, everyone was petrified of having another GFC. So we had all sorts of things going on. We had sovereign debt crisis in Europe. We had all sorts of other concerns about inflationary shocks, fiscal outlook shocks, cycles in all sorts of markets. And guess what? Markets kept powering on, right? And so that's one example. Another example would be interest rates over that period were remarkably low. Inflation was low. We had negative bond yields in a big part of the global bond market. And I think there was this expectation that this is just going to last forever. And that obviously has not been the case. And so I thought I was going to have to go into a new career. I think in 2021 might have been the rock bottom of bond yields, where cash rates were basically zero, bond yields were zero or negative. And that's all changed, right? The inflation outlook has repriced bond yields, and now we're in a world where bonds actually look pretty attractive again.
And Richard, linked to that, you've got the challenge of deploying capital. Where do you find the most compelling opportunities in global fixed income right now?
There are always opportunities, I would say, first and foremost, regardless of what's going on in the macro or the micro. The first point is around developed market interest rates, duration, government bonds. A little bit cautious, as you can imagine, right now, given the inflation outlook. And I'd say in portfolios, we've been biased to be underweight, particularly in places like the US. But getting interested as bond yields go up, because if there is some sort of global recession, or at least a growth slowdown or demand destruction, we likely will see a bond for high quality sovereign duration. So something we're really keeping an eye on from that front on the DM side. Another one, maybe something unique to how Brandywine manages money, or Franklin Templeton more broadly, is that we're fairly unconstrained. And one area that's really interesting is emerging markets debt. And within emerging markets debt, there are certain pockets, not everywhere, that have bond markets have really high real yields. And so we actually really find value in certain Latin American government bonds in the local currency term. So if you take them unhedged, you're getting very high nominal yields, extremely high real yields, because inflation expectations are quite low, and potentially the benefit from the currency. That is a big wild card. We could talk about that a little bit later. Front-end credit is still interesting. So credit markets, spreads are tight, but there are certain pockets where you're insulated from spread widening if you have shorter spread duration in your portfolio. So certain BBB, BB, more liquid parts of the credit world look pretty good. And then finally, within the whole securitized world, again, pockets. So just your plain vanilla, high quality agency mortgages in the US, basically implicitly or explicitly government guaranteed. They look very good relative to corporate bonds. And then other areas like tying to the AI theme within the ABS world, data centers. So data centers look interesting. These are secured, right? These are not unsecured, which is what all the Mag 7 are looking at issuing right now. And so if things go south, well, you've got some protection there.
You touched on duration. For advisors that talk to clients that are wrestling with whether this is a strategic opportunity or something tactical, what message do you give them?
So I would say this is definitely strategic. So bonds play a role in a portfolio. And understandably, I think advisors or any investor is cautious after what happened in 2022, right? It was the biggest drawdown in fixed income history, more or less. But that's not just because bond yields went up a lot. They did. It's because the starting point was so low. So we had government bonds trading between 0 and, I don't know, 2% or 3%, depending on the market. So we have a lot more cushion these days to protect people. The other thing is clearly correlation between risk assets and defensive assets. When I talk to a client, the first thing I ask them is, what role is this playing in the portfolio? If the role is, I'm just very growth seeking, well, that's a very different, or income or a high growth seeking, very different portfolio than if this needs to be your anchor against your equity portfolio. Why do you have bonds in the portfolio? Generally, most people do to offset. It's like the anti-equity, right? Apart from like capital market theory, efficient portfolios, these tend to be good things to have for diversification. People want to stay the course. And if you don't have bonds, you're probably not going to stay the course because you won't be able to stomach the drawdown that's inevitably coming. Now, tactically, well, I might be talking my book, but hiring an active manager to allow you to do that quickly, right? Because these moves can happen very quickly, and dial up or dial down the overall duration makes sense.
And linked to that, Richard, when we think about the credit risk that investors are currently facing, is that underpriced right now?
So I'd say generally speaking, yes, at least historically speaking. And I'll give a few caveats to that. So credit spreads, which is really the additional compensation that an investor gets to invest in a default prone or potential default prone instrument over government bonds, are very low. They're like have been around all-time tights, depending on how you calculate that. They trickled out a bit, but have been remarkably stable, even during recent risk-off events. However, credit spreads aren't the only measure of value within the credit world. And credit means more than just corporate bonds. It could mean anything that could default. I mean, some people would lump emerging markets into that, certainly securitized into that. So we look at things like the all-in yield. So right now you get a high yield, the index, and individual bonds are higher than that. Index is at 7.8%, global high yield markets. Investment grades, call it around 5%. So these are decent all-in yields for, depending on the part of the market, reasonably, high quality instruments. Technicals have been strong, fundamentals have been strong, defaults have been about half of what they normally are, which is between 3.5% and 4%. And so you're not getting a ton of protection against the default cycle. If you keep it short dated and are selective and active, credit can still make sense now.
Now, Richard, you have a wonderful lens. You get to look across the whole Franklin Templeton fixed income family. Is there anything that you think Australian advisors and Australian portfolios more generally are doing differently, or they're missing out on? Or is there anything that for the global market they're not quite aware of?
Look, I think there absolutely is a place and should be a place for Australian bonds and fixed income in a local domestic fixed income portfolio. But I think the number one point I'd tell people is that, or they tell me, is that they don't think it's necessarily needed. Right? I don't need that. I've got cash or term deposits. I've got some hybrids, which we know that market's going away eventually. I have maybe some Aussie core bonds, and that'll do me. I've got my property. That's an income type play. I would say that, first of all, Australia is only 1.5% of the global bond market. So it's very small. It's fairly concentrated. I mean, the duration's a bit lower. The other thing is people think it's global is complicated. It's really not. I guess it keeps people like me employed explaining it. But global bonds, they act and look like Australian bonds. The one thing you have to be careful about is the currency. You tend to want to hedge that. And we have been doing this for a long time, and most of the world has been doing this for a long time, and we hedge the currency fairly effectively. So that's something to keep in mind and ask about. The final thing is the correlation to broader bond markets. So Australia, our economy here, whether we like it or not, we're kind of a taker to a degree of what happens globally, what happens in the US, what happens in Europe, what happens in China, what happens in the US dollar really is going to drive our market, our economy and our markets. So if US Treasury bond yields go up 100 basis points, guess what's going to happen to Australian government bonds? They're going to go up too. Now, we do have some idiosyncratic things going on, and there is absolutely differentiation going on right now in global bond markets. But these are very correlated. And so having more diversification, a broader opportunity set makes sense.
Now, Richard, you touched on it there, the correlations. If I just think about the role that global bonds could play in an advised portfolio, if they're not currently there, where would it sit in terms of the yield profile, the ability to be resilient in different conditions? What sort of role does it play? What's it complementary to?
Yeah, so I mean, it really depends if this is the defensive part of your bucket or the return-seeking part of your bucket. I'd say most of our clients have it doing a little bit of both. And so the common ways that investors structure fixed income within a broader asset allocation, number one would be like a barbell strategy, where they say, okay, I'm just going to have some boring core bonds here, whether they're domestic or global, and I'm going to have some satellite kind of more exotic or higher return seeking bonds over here, whether that's, I mean, that could go even all the way up to private credit or high yield or emerging market debt or securitized, but you gotta have a higher alpha piece over here. So that then when you blend them together, you get a fairly defensive, but also return and income producing portfolio. Another way is really replacing passive, and we could get back to passive. I think we will, but you know, if you're not comfortable with just allocating the market, because the market is what the market is, and that might not suit your needs, then going active really, I think, makes sense. And then the final one is local global. So you have a local Aussie domestic, whether it's core, an absolute return type strategy, or even cash, right, on this end, and then you pair it with a global manager. I think that makes sense. But yeah, it really comes back to what you're trying to deliver in the portfolio. And I really do think bonds still should play largely that defensive role in an asset allocation.
Let's come back to that whole passive active. You know, there's a lot of conversation this month about the merits of being really clever about fee budget and diversification. But active management in fixed income is quite different to equities. What's your observations here about the role of active management?
Totally. Well, look, most active managers outperform or have, and so that's one big difference. Not to say global equity managers or equity managers can't. It's just they've struggled in recent years for sure. Look, the whole passive active debate in fixed income comes down to whether the benchmark is the right starting point. And look, I think fixed income is pretty obvious. These are market cap weighted indices. So basically the most indebted issuers get the biggest weights in the index. It doesn't really matter what yield they're at. They could be low yields, they could be high yields. And also the overall profile, whether it's the overall yield or the duration of the index, you're just taking whatever the market gives you. And a little bit of history here. I mean, I'm dating myself here, but I remember when the Global Ag was run by Lehman Brothers. And so it was the Lehman Global Ag. And then it changed after the GFC to the Barclays Global Ag. And then after that, it was the Barclays Bloomberg Global Ag. And now it's the Bloomberg Global Ag. But over that time, way back when the Global Ag started in the early 2000s, it had a duration of around 4.5, maybe 5, and it was around that level for a long time. Post GFC, it just started going up and up and up and up. Eventually got to above 8. Now, the question I would pose to people is 8 the right number for your portfolio? Is 4 the right number for your portfolio? Well, that's something you need to figure out or have a think about. I wouldn't just take what the market gives you and leave it a day, because it might not be appropriate. There's no real fundamental justification why the market's the way it is. So the other thing is it's 53% government bonds. It's 15% government related, like quasi-governments, supranationals, that sort of thing. 18% corporates and 13% securitized, all investment grade. This is the global aggregate I'm talking about. What isn't in there? High yield, so anything that's sub-investment grade. Any emerging market debt, well, certain pockets of EM are in there, but most emerging market debt markets, certainly anything sub-investment grade, is not in there. And so you're missing big parts of the opportunity set if you're passive. So there are a number of reasons why it makes sense to be active in fixed income, and it's why most managers tend to outperform. They can go to the right places at the right time.
So Richard, as we close out, and I hope we'll keep talking in the months and years to come, if I just think of the remainder of this calendar year, just a 12-month call for the bulk of 2026, you obviously don't want to give away all the secret sauce. There's a lot of skill that goes into what you're doing, but could you give this audience of advisors one conviction call that you think they should really pay attention to?
Sure, I'll give you one conviction call, but let me make a general statement first, which is diversification. That is not a satisfying answer for the audience. I accept that. But in this kind of environment, that's really the only way, because we really don't have all the answers, but we do all the analysis and we react to the data as it comes out, and we have our leads. But the other thing is that we want to be capturing the higher yields being offered in the market. And they're really nice, juicy, real yields, like inflation-adjusted yields. This is the best sort of expectation on future returns in the bond world. This is why back in 2022, it was so difficult, because our starting point was often negative real yields. And so going forward, if someone asks me, what's the return profile for the next 10 years? I say, well, what's the yield on the index? That's a good starting point. That's most likely what you're going to get, or something around about. So in terms of high conviction, let's go back to the emerging market world and tie it into currency a little bit. So one of the areas with the best real yields in the world are Latin America. And you have to risk size it appropriately in a broader portfolio. And with that caveat, there are markets like a Brazil, like a Colombia, like a Mexico, right, that are trading at really healthy real yields where inflation has been coming down. And it's really that spread between nominal yields and inflation that gives you the real yields. So real yields look really good. If you take that in local currency terms, you can benefit if those currencies appreciate. And given what's going on in energy markets, I think we think this part of the world will be beneficiaries of the U.S. bringing things back to the Western Hemisphere. There's lots of natural resource rich in this part of the world. I think there'll be a lot of development there going forward. So not only cyclical story, but more structural story in that part of the world. So going back to the currency, look, part of this depends on the future of the US dollar. There's something that we talk about and a framework we use out there, a lot of people do, called the US dollar smile. And think of a smile. The US dollar tends to do really well on both ends of the smile. When there's like a crisis or like a big, deep global recession, or on the other side, when you have US growth outperformance. So in the medium to long run, what really drives currency performance are interest rate differentials do matter, but it's really growth differentials. And the reason why the US dollar had done so well over the decade prior, if not longer, is because the US growth has outperformed most of the rest of the world, or certainly most of the developed world, right? And so our thesis kind of going into this was that, and last year we saw a taste of this with the US dollar falling, is that we might just see expectations reverse of it a bit. We might see capital flows, all that money going into the Mag 7 and US equity markets being like 65, 70% of the world. Doesn't need to go down that much for it to impact currency markets. And so we've seen a taste of that. And so we like, some of these Latin American currencies. We like the yen, we like, the Korean won, even the Aussie dollar right now. And you've got to fund that with something. So US dollars partly, we have shifted some of that just given what's going on to the euro, and selling some euros to back that. But that is a really interesting, I think, not only trade, but structural position that could add a lot of value in portfolios.
You're very generous to offer it to this audience, and I hope they've been inspired and that they should get in touch if they've got their own questions. Richard, thank you so much for your time.
Brilliant. It's great to be here. Thanks.